On March 9, 2009, the S&P 500 finished the day at 676 points. The financial system was unraveling. 6 months earlier, Lehman Brothers had collapsed. Retirement portfolios had been slashed in half. News headlines warned of the most severe economic downturn since the Great Depression. Fear dominated the country. At that moment, a school teacher named Margaret made a decision that seemed irrational to almost everyone around her. She invested $50,000 money she had carefully saved for a house down payment to a basic S&P 500 index fund. Her friends believed she was making a terrible mistake. Her family urged her to wait until the chaos subsided. She chose not to listen. Today, that $50,000 has grown to roughly $590,000. She did not select individual stocks. She did not perfectly time the market. She had no privileged information. She simply understood that rare moments arise, perhaps once or twice in a generation, when widespread fear produces extraordinary opportunity. Moments capable of transforming ordinary individuals into millionaires. Most people fail to recognize that we are experiencing a similar inflection point right now. It is not a market crash, but something potentially even more powerful. A historic convergence of forces, not seen in nearly a century. These forces are set to shift more wealth to everyday Americans than any prior event in the nation's history. The figure is $124 trillion. That number is accurate. Over the next 2 decades, $124 trillion will change hands, and most people neither realize it nor understand how to position themselves to benefit. The period following March 2009 demonstrates how everyday individuals accumulate extraordinary wealth. The S&P 500 did more than recover from its 2009 loot, began the longest bull market in American history. From March 2009 through January 2026, the index climbed more than 900%, recently surpassing 7,000 points for the first time. An investment of $100 at the bottom grew to approximately $1,000. The primary beneficiaries were not hedge fund managers or Wall Street traders, but teachers, nurses, accountants, and small business owners who consistently contributed to their 401ks and IRAs, while others panicked. The numbers tell a striking story. In 2010, there were about 8.4 million millionaire households in the United States. By the end of 2024, that figure had nearly tripled to close to 24 million. More than 15 million households crossed the $1 million mark in just 14 years, roughly equivalent to the entire population of the New York metropolitan area becoming millionaires. Most of these new millionaires were not startup founders or executives exercising stock options. They were ordinary individuals who participated in rising markets through retirement accounts and index funds. According to UBS's 2025 Global Wealth Report, the United States added 379,000 new millionaires in 2024 alone, more than 1,000 per day. These individuals typically reached millionaire status through steady asset accumulation, rather than dramatic windfalls. UBS refers to them as everyday millionaires, those with net worth between $1 million and $5 million. Globally, this group has quadrupled since 2002, about 52 million people, collectively holding more than $17 trillion in wealth. Their path is not hidden. It is documented, repeatable, and about to become even more accessible. What elevates the present moment beyond 2009 is what researchers call the Great Wealth Transfer. According to Cerulli Associates 2025 research, approximately $124 trillion in assets will transfer between now and 2048. This represents the largest wealth shift in human history. Nothing in recorded economic data compares. To provide context, $124 trillion exceeds the combined annual economic output of every country on Earth. It is more than 5 times the current U.S. national debt. It reflects 8 decades of accumulated American prosperity, preparing to move across generations. The mechanics are clear. Baby boomers, born between 1946 and 1964, control roughly 52% of U.S. wealth, about $78 trillion concentrated within one generation. The youngest boomers turn 62 this year, while the oldest approach 80. Over the next 20 years, their wealth will pass to children, grandchildren, and charitable causes. Cerulli estimates $16 trillion will go directly to heirs, and $18 trillion to charitable organizations. Generation X is expected to inherit approximately $39 trillion over 25 years. Millennials are projected to receive around $46 trillion. Generation Z will begin receiving substantial inheritances as the transfer accelerates in the 2030s and 2040s. Timing is critical. Generation X, sometimes labeled the overlooked generation, is expected to receive about $1.4 trillion annually over the next decade, arriving during a stage of life when many support both aging parents and their own children. For them, this wave could reshape uncertain retirement outlooks. Millennials may wait longer, but are set to inherit larger totals during their peak earning years, amplifying the compounding effect of inherited capital combined with career income. However, the real opportunity extends beyond direct inheritance. When $124 trillion moves, it does not remain idle. It is invested, spent, and deployed into businesses, property, and financial markets. Each dollar in motion generates secondary opportunities. The last comparable moment occurred after World War II, when returning soldiers used the GI Bill to buy homes, start businesses, and build the American middle class. That period of expansion produced the baby boomers, who are now transferring their wealth. History is repeating itself at a far larger scale. The parallels to 2009 are deeper than they appear. In 2009, three factors aligned. Assets were heavily discounted after a 57% market decline. Massive capital injections arrived through stimulus and quantitative easing, and most people were too fearful or financially constrained to act. Today's environment differs in mechanism, but shares structural similarities. Markets are not collapsed, but the redistribution of wealth will create both disruptions and opportunities. Some assets will be liquidated to settle estates. Others will be reinvested by heirs with different priorities. Such movements create entry points for prepared investors. This time, the capital injection is not from government stimulus, but from the wealthiest generation in history, passing assets to their heirs. For perspective, pandemic relief totaled around $5 trillion. The wealth transfer equals 25 times that amount flowing through the economy over 2 decades. Yet it receives only a fraction of the attention devoted to daily market fluctuations. The individuals who built wealth after 2009 were not uniquely intelligent. They were positioned when opportunity appeared. The same principle applies now. Importantly, inheritance alone will not create most new millionaires. Sorelli estimates that 62% of transferred wealth originates from high net worth and ultra high net worth households, about 2% of families. The transfer is concentrated. Most households will receive modest amounts, or none at all. Relying solely on inheritance is therefore ineffective. The broader opportunity lies in participating in an economy energized by $124 trillion in capital movement. When trillions enter investment accounts, asset prices rise. When heirs purchase homes, real estate values increase. When inherited funds seed new businesses, job growth accelerates. Rising capital flows lift multiple asset classes simultaneously. Understanding where money will flow is equally important. Research from Bank of America, Merrill Lynch, indicates younger investors differ significantly from baby boomers in investment preferences. 72% of investors aged 21 to 43 believe traditional stocks and bonds alone cannot deliver above-average returns. This generational shift will redirect trillions. While boomers favored blue-chip stocks and bonds, heirs show stronger interest in alternatives, private investments, and emerging asset classes. Sectors aligned with these preferences: artificial intelligence infrastructure, clean energy, healthcare innovation, and digital assets are positioned for substantial capital inflows. This does not require abandoning broad markets, but it does require recognizing shifting capital trends. Real estate will also be reshaped. Demand will increase as heirs buy homes, while supply rises as inherited properties hit the market. Suburban and retirement-heavy areas may experience inventory growth that moderates prices. Cities attracting younger professionals may see intensified competition. Since 2000, median home prices have risen over 150%, though unevenly. Markets tied to technology and population growth have far outperformed those losing residents. Geographic positioning will influence wealth outcomes over the coming decades. Remaining invested through volatility remains the most reliable strategy. Margaret did not need complex tactics, only capital and discipline. Historically, the market has returned around 10% annually over long periods. Investing $500 monthly in an S&P 500 index fund starting in 2009 would have produced over $250,000 by early 2026, excluding employer matches. Yet that journey included the European debt crisis, the 2013 government shutdown, the 2018 trade tensions, the 2020 pandemic crash, and the 2022 bear market. Each time, predictions warned of lasting decline. Each time, recovery followed. Research from Goldman Sachs demonstrates that missing the 10 best market days since 2009 reduces annual returns from roughly 17% to 12%. Missing the 25 best days cuts returns nearly in half. The strongest days often occur amid peak fear. The wealth transfer era will likely feature similar volatility. Consider a 35-year-old investing $500 per month for 25 years. At a 10% annual return, $150,000 in contributions grows to about $665,000. At 7%, it reaches approximately $405,000. If economic growth runs even 1% higher due to increased capital flows, that 7% becomes 8%, raising the outcome to roughly $475,000. Doubling contributions to $1,000 monthly increases the 10% outcome to about $1.33 million. Consistency alone can produce millionaire status. Industries facilitating wealth movement: financial planning, estate administration, tax advisory, wealth management, legal services, and real estate will expand significantly. Sara Lee estimates $54 trillion will first transfer to surviving spouses, with nearly $40 trillion going to widowed women, creating a substantial market for advisors specializing in serving women. The shift is gradual, spanning decades rather than occurring instantly. The transfer is already underway. The oldest baby boomers are 79 in 2026. There is no single bottom to time. It is a 25-year process. Weighting forfeits, compounding time. The information is public. The 2009 opportunity was visible to anyone with a brokerage account. The $124 trillion transfer is documented in accessible research. Yet many remain inactive due to fear, distraction, or short-term focus. An action framework includes maximizing tax-advantaged accounts, such as 401ks and IRAs, maintaining diversified market exposure through low-cost index funds, developing skills aligned with wealth movement, holding liquidity for opportunistic investments, extending time horizons, considering geographic positioning, and engaging in thoughtful family estate planning. For 2026, the 401k contribution limit is $23,500, with an additional $7,500 catch-up for those 50 and older. Historically, America has experienced several transformative wealth-building eras: post-Civil War industrial expansion, the post-World War II boom, the 1982 to 2000 bull market, and the 2009 to 2026 recovery, during which the S&P 500 climbed to 7,000. Each era created millionaires who simply participated. The Great Wealth Transfer represents the next chapter. Over 25 years, $124 trillion will move. Economic activity will expand. Asset prices will be supported. Opportunities will surface. The transfer is not hypothetically. It's happening now. Margaret did not know she was seizing a once-in-a-generation opportunity in 2009. She recognized value created by fear and acted. Today's opportunity differs in structure, but not in scale. Trillions are shifting. Millions of new millionaires will emerge. This era will be remembered as a defining wealth creation period. You understand the scale, the timeline, and the strategies. What you choose to do with that knowledge will determine whether you look back on this era as the turning point that changed everything.